Hello, I'm certified financial planner Wes Caprill, and this is Wealth Wise Women, the show that's rewriting the narrative that personal finance and investing are just for men and just for insiders. Because whether or not the rest of my industry realizes it, the future of wealth in the United States is female, and I aim to foster that future one episode at a time. So, join me every week as I attempt to add humor and entertainment to the otherwise snooze fest that is personal finance, addressing various topics along the way from the lens of how they affect women in particular. And if you like what you hear, be sure to subscribe to our channel and our newsletter, the link to which you can find on the screen or in the details below. That being said, let's get to this week's episode. Hello there, and welcome to another episode of the show. In this week's episode, I want to talk about the topic of financial scams. According to the Federal Trade Commission, women are targeted by financial scams 26% more than men are. Now, I'm not going to dive into the reasons behind why women are targeted more, but instead what I want to do is talk about at least what I'm calling a scam that I recently came across, because I think it's very, very important to get awareness about it out there to everyone. Now, what I will be telling you about is technically legal, so I guess you can't quite call it a scam, but just because something's legal doesn't make it any more ethical than an actual illegal scam. So I'll get to that in a minute. But I think a lot of us are familiar, if not all of us, are familiar with a lot of the financial scams that are out there. I mean, there's the granddaddy of them all, the Nigerian prince who sends you an email and says he needs some money to unlock a greater fortune, and he'll share some of that fortune with you if you send him some money now. The call centers have been very active lately, and they'll give you a call and say, hey, there's a warrant out for your arrest from the IRS, and you need to go take out some gift cards from Target in order to get that warrant to go away. There's one, though, that's been popping up. I've been seeing it pop up a lot recently. That's very scary. The same call centers have been using AI to impersonate real people's voices. So in one example, what they've been doing is impersonating a grandchild's voice and calling the grandparents. And so the grandparent thinks that they're actually talking to their grandchild, and the grandchild is saying, hey, I've just been arrested and I need money for bail. I mean, it's very convincing. And so these poor grandparents think that their actual grandchild is in jail and they need to take out money in order to get them out. So a lot of these illegal scams have become very, very sophisticated. But like I said, today's topic is about what I would call a legal scam. And I want to dive into it in a little bit more detail. First, though, I want to talk about something that was popular several years ago. Rather, it was in the news a lot. And that is what's called the Special Purpose Acquisition Company, or SPAC. These SPACs became popular about 5 years ago. And what they were is they were public companies that didn't actually do anything. So these pools of investors would come and form these SPACs, and they would put them on a public exchange. They were public companies. And then what they would do is go out and find a private company to purchase. And essentially what it was is it was a way to take private companies public and bypass a lot of the regulations and the time it takes to take a private company public through what's called an initial public offering. Now, it's probably no surprise that a lot of these SPACs ended up losing money. You know, just like everything, I've talked a lot about bubbles in the past. This one could qualify as a bit of a bubble. Sure, some SPACs were successful, but a lot of them ended up losing money. A lot of them weren't able to even find a company to buy. So they just ended up doing nothing. And so that was kind of one of those that was like a legal thing, but I couldn't help but kind of view it as a bit of a scam. They were trying to bypass a lot of the regulations, which, don't get me wrong, I'll be the first to say there's a lot of bureaucracy in the government and a lot of over-regulation. But when it comes to initial public offerings, and call me a little bit cynical, but when money's involved, people will cut corners. And certainly these companies that are going public will try and find a way to hide, some of the stuff that they don't want to go public. They want themselves to look really, really good in the initial public offering phase. So, they're going to hide as much as possible, but the regulations behind going public are meant to uncover anything unsavory. So that way investors are protected when these initially private companies go public. I mean, WeWork is a great example of that. WeWork was this private company darling that had raised billions of dollars, and their IPO was very much anticipated. But then, as soon as they filed for the IPO, people started uncovering, because they had to open their books to everybody. People uncovered a lot of weird, unethical practices that WeWork was doing, and all of a sudden, the company pretty much went belly up. They are a fraction of what they used to be. And Adam Neumann, yeah, he got a heck of a golden parachute, but he's out of the picture. So the regulations are there for a reason, because initial public offerings should be safe for investors. Now, here's the thing. With initial public offerings, they're usually reserved for large institutional investors or very wealthy investors. The average person typically is not able to get in on an IPO on the ground floor. Whether or not that is fair, I'm not going to touch on that. But because of that, companies have said, well, we want to find ways to be able to offer securities to the average investor. And let me combine that with, what are the various ways that private companies can raise money? So, the SEC says, all right, when it comes to an initial public offering, there's a lot of regulations, but there are also other ways that companies can raise money, or rather, it's not as stringent of a process to file with us to raise money if you're not necessarily going fully public. So there are various different ways that private companies can raise money. One of those is through what's called a private placement. So private company A will say, hey, we want to raise money, issue securities. We'll do it through a private placement. But here's the issue with a private placement. You have to find accredited investors, meaning they have to have a certain amount of assets and income in order to qualify to be able to invest in this company. Now, a lot of that is because of illegal activity that happened way back when these regulations were first put into place. Companies were trying to raise money from the general public, and then they were just disappearing into the wind. So they wanted to make sure that only accredited investors who could afford essentially losses were the ones that were investing in these private placements. But another one is called Regulation A. What Regulation A is it's called a mini IPO. It is a way for a private company to offer shares of the company to the average person. So it does not require the same level of accreditation as a private placement does. And it does not require the same level of filing with the SEC as a public offering does. So there are a lot lower barriers to entry. Now, there are limits to the amount that can be raised. That limit is $75 million. So it's a very, very high limit. But Regulation A says, okay, private company can go out and raise money from the general public. Great way, at least at face value, for the general public to be able to invest in a private company. And if that company does end up going public, they've gotten in on the ground floor. Here's the thing. Why haven't we heard much about Regulation A? Well, it's because frankly, or rather Regulation A offerings, it's because they're not all that popular. Probably not a surprise. A lot of them don't do well. Very few actually succeed. I mean, there's kind of a thought that if the investment isn't all that appealing to the institutional or the large investors, then why wouldn't they invest in it? Why would the company go straight to Regulation A? If the demand is there from just a handful of investors at a high level, they wouldn't need to then go spend marketing dollars on trying to raise money from the general public. So there's that first sense of skepticism that you're like, why is a company offering shares through Regulation A? Why weren't they able to raise money in other ways? All right, so why am I bringing all of this up? Well, the scam, that's what I'm calling it. So it is legal. It's not technically a scam by any means. I was recently sent one of those email newsletters from a client, one of those daily ones, and he raised awareness to me of this ad that was in this newsletter. The headline of it is Zillow's co-founder has a big idea. Now, this company, it's called Picasso, P-A-C-A-S-O, and it was co-founded by the co-founder of Zillow. And he has a quote in here that says, I wish we had done a round accessible to retail investors, meaning you and me, prior to Zillow's IPO. And so now it says he's doing just that. With Picasso, what they're doing is you can invest in Picasso as a private company. They have a very slick website that is literally called invest.picasso.com, where you can go and say, I'm ready to invest in the company. And for just $1,002.40, you can invest directly in Picasso. You might be thinking, cool, that's actually a great way for the average person to get in on the ground floor of a startup. And by all means, yeah, it absolutely is at face value. But in this line of work, I've learned that you have to have a little sense of cynicism and skepticism when it comes to investments like this. Now, there is one major red flag that immediately stood out to me in this email that this client sent me. At the very bottom of this ad, because let's be honest with you, it was an advertisement in the newsletter. It was disguised to look like a posting as part of the overall newsletter, but it was an ad because it literally says in partnership with Picasso. The last line says you can join them for just $2.80 a share. Even better, their private stock isn't subject to public market volatility. That line right there sent the alarm bells going off in my head. What I read that is that's their way of saying this is a private stock and it isn't subject to any market volatility. By investing in this, you are safe from all the craziness that is in the public stock market. So come put your investment dollars in us. It's not talking about the fact that this is entirely a speculative investment. It's a startup. This is one of those situations where the entire thing could go belly up and you get absolutely nothing. Yes, there is volatility in the public market, but there's also even more volatility in private companies and having your stock in them because it all comes down to marketability and liquidity. You can't get your money out of this investment all that quickly. I went on their website and I was diving into it a little bit more, and I saw something that said how you could see a return. There's only two ways. One, through an IPO. You could potentially sell shares if Picasso goes public, or two, through acquisition. Possible payout if Picasso is acquired by another company. It says nowhere in there about you being able to cash in your investment if neither of those two things happen. So there's a couple things here. You can entirely lose your money if the company goes belly up. If it gets acquired, you're hoping that it gets acquired for more than you bought in at. You may actually get less money than what you invested if the company gets acquired, because it could get acquired for less than its so-called value. And then IPO, we've already talked about the fact that an IPO is very, very strict in what you have to file and all the disclosures that you have to make. And I might do another show on this where I go a little bit deeper into this Picasso situation. But from what I had been reading too, a lot of the facts and figures that they were putting out there were kind of a little bit of smoke and mirrors tactic. It didn't sound like what they were marketing in terms of revenue and all that would have flown by the SEC. So, who knows if they'll even go public. All right, so what am I trying to say here? Again, this is a legal situation. There's nothing illegal about what Picasso is doing. But instead, what I want to do is make people aware of just because something's legal doesn't make it any less of a scam as something like an actual illegal scam. I am very, very appalled by the way that they are trying to promote investing in Picasso. I mean, just that line about their private stock isn't subject to public market volatility is just a wild, wild thing to put in writing. Yes, obviously that is true technically because you're not in the public market, but that doesn't make it any less risky of an investment. In fact, it is even more risky of an investment. And in fact, it's not even subject to volatility. It is subject to complete speculation and complete risk. And I've talked about this before. Difference between volatility and risk. Usually with volatility, you don't have a risk of losing all of it. I mean, if you're invested in mutual funds, you're not going to completely lose all value of your money. There's a very infinitesimal chance, or very, 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 very small chance. But with a private company like Picasso, it could go belly up and you completely lose everything. So there is huge risk behind it. Yeah, it isn't subject to public market volatility. It is subject to private market volatility, which is even more severe. I am curious to see if this is part of a trend. Just like SPACs were a trend about 5 years ago, could Regulation A be the latest trend for these private companies to try and raise money? I don't know. We'll see. But I wanted to make people aware that if you see something like this in a newsletter, be very aware of it. I hope this was informative. If you have any questions about this, if anything wasn't clear or you want to discuss further, please let me know. I would also love to know if you've encountered anything similar to this. Send it my way. Send me an email, wescaprill@moneyandclarity.com, or book some time with me. Visit withmc.com. Financial scams are becoming way more sophisticated, the illegal ones and the legal ones. I'm calling them scams because that's honestly what they are at the end of the day. It's a way for somebody else to get rich at somebody else's expense, whether or not we like it. Would love to hear if there's other situations like this out there that I just haven't been made aware of. That being said, hope you enjoyed this episode, and I'll see you next week. Take care.